So the Basel capital rules only did half of the protection that I think regulators and society is looking for. If you really want to tackle too big to fail, you're going to have to do it through leverage ratios.
Why? Because you don't trust them to risk weight their own assets?
No, because government securities have zero capital weightings, and so it doesn't. So Basel capital rules doesn't impact government securities, and so institutions can have very leveraged balance sheets. And still conform to the capital rules. And
so long as it's all government bonds.
Sure. But that raises a huge issue now. And so if this goes through, these institutions have two valves to mitigate the problem. They could raise a lot more equity to keep their balance sheets, or they're going to have to shrink their balance sheets.
By selling off.
Or not reinvesting in treasuries and more government-based mortgage securities.
So you could have banks selling off at the same time as the Fed is tapering off?
Yes.
And that's where
I mean, this is proposed for a 2018 implementation, but the market is very, demanding. So I would not be surprised when earnings are going to be coming out this week and next week, where the financial analysts are going to be asking the leaders of these firms, what are you going to do about it? Do you intend to raise new equity, or are you going to be shrinking your balance sheet, or are you going to defer dividend payments to raise your equity? There's three valves. It's either capital or retain earnings or shrinking the balance sheet. If they shrink their balance sheets, we're going to have a more aggravated problem in the future, because banks are the largest owners of U.S. treasuries.
What does that aggravated problem look like?
Well, as you said, at the same time, the Fed is taking their foot off the pedal and not buying assets. At the same time, you would have banks also not buying, rolling over into new treasuries. And so, obviously, then we would hope the deficit reduction is even larger from the...
That's a big hope.
Right. But we may have an imbalance. And if this could be another reason for a faster rise in interest rates.
Very quickly, how destabilizing is that for the economy, if it happens?
It's destabilizing if interest rates go up so high enough, fast enough, that it impairs the opportunities you have in equities. So when fixed income becomes a better, safer place for investing in the future. Right now, with interest rates where they are, equities still represent a better risk return than interest rates.
That could change.
But if interest rates went up to 4.5%, let's say, then you have different issues.
All right, much more to come with Larry Fink. He's the chairman, the CEO, and the founder of BlackRock here on Market Makers.